Today we're going to do a little preview of what's going to come up this week. That includes Powell's speech on Tuesday and Nonfarm Payrolls on Friday. And we're going to do a seasonality analysis for July for the stock market. And I think it's going to be a very exciting month for equities, you will see later when we show you the charts of how the equity market has historically played out each day of the month. And let's get started. So we start our preview with actually a little recap from last week's important set of data, which was the May PCE that came out on Friday. The headline PCE came essentially flat month on month from April, and the core PCE rose just 0.1% month on month. So that brings both the headline and the core PCE to 2.6% year on year. The difference is that the core PCE excludes food and energy, which are quite volatile. If we look at this chart now, what we had was that inflation was steadily coming down in Q3 and Q4, but it's essentially hit a roadblock coming into New Year. And in fact, the headline PCE even rose in March and stayed there in April. And this 5 months really got the Fed worried about a scenario of sticky inflation. This is why recently the Fed has been pushing back the narrative of early rate cuts. So the fact that the May PCE starts now trending down again from April is really good news for the Fed. And I suspect what they're going to say is that they want to see more of the same good data until going into at least September before they think about the rate cuts. On a 3-month annualized basis, and what this is just we take the past 3 month data and extrapolate for the whole year. We see that inflation in the short term may have peaked in March, and on a 3-month annualized basis, April and May are trending down. Again, this is very positive news for the Fed. And I'm sure they want to see more of that before they make the big decision of the first rate cuts. And speaking of rate cuts, in the June FOMC, essentially the FOMC members were stuck between 1 cut versus 2 cuts, and the median dot was on the 1 cut for this year. But the market is still sticking with the prediction of 2 cuts. And we observe that through the Fed funds futures, which are actively traded on the CME. We essentially interpolate the Fed on futures with the FOMC meetings to see how many basis points of cuts is each meeting priced in by the market. We see that the market believes that we'll see the first cut in the September FOMC and the second cut in December FOMC this year. So looking ahead for this week, Powell speaks on Tuesday, which is tomorrow. We're going to do a little recap of what he said in the June FOMC as well. And on Friday is the big set of data of Nonfarm Payrolls. So the Fed has 2 mandates. First is maximum employment, which is the notion that if you want a job, you can get one. And the second mandate is price stability, which is defined as 2% PCE inflation. In the June FOMC, Powell was quite happy about the progress made in the CPI report on the day. But he basically said we want to see more. And he doesn't really expect the labor market to substantially weaken in the coming months to warrant early loosening of the policy. And 4% unemployment rate is still historically low. If we don't get the 2 cuts this year, they're just going to add an extra cut for next year. And 15 out of the 19 FOMC members chose between 1 or 2 cuts for 2024, and the other 4 essentially saw no cuts. So, think about non-farm payrolls. Can we predict it? Well, non-farm payrolls is negatively correlated with initial claims, which actually has come out for June already. But the problem is that recently there has been a discrepancy between the direction of initial claims and non-farm payrolls. So typically what we would expect is that if initial claims go up, as in more people claiming benefits for losing their jobs, we should see non-farm payrolls go down, or not being as strong. But in the past few months, there has been a decoupling of those 2 sets of data, where initial claims have been going up, but non-farm payrolls have also been very strong. So in June, the initial claims did go up slightly. Does that mean non-farm payrolls will weaken? It's quite hard to say now. I mean, historically, yes, but because of the decoupling, it's much harder to say. And it's not easy to predict non-farm payrolls with inflation. If you compare historic CPI levels versus non-farm payroll prints, there's essentially no relationship. Things are everywhere. And the Fed actually recognizes that, because for the past couple of years, inflation has been coming down, but non-farm payrolls have been very strong. And that's because structurally, there's the supply side of the non-farm labor market is lower than the demand side. So there's been a supply-demand gap, which have favored the workers. But hourly earnings are associated with the CPI. So strong hourly earnings each month tend to lead to higher CPI. And this is because the labor costs go up. Employers can try to pass on some of that cost into the price of the products and services, which would lead to a high inflation. So those two charts are actually, representations of the same underlying data. We see that hourly earning increases move in line with CPI or vice versa. So there is a positive association between the two. So what the Fed really wants to see is that as the labor market cools, unemployment rate rises, we also see a cooling in the average hourly earnings, which can hopefully also cool down the services inflation. And finally, exciting news for July is that July is a very good month for equities generally. So I've done the analysis for both SPY, which is the ETF for S&P 500, and QQQ, which is the ETF for NASDAQ. So we can see for SPY that in the first 15 days, the market rallies a lot. And even if we look at the weekly increases of the year, so currently we're in week 27, it's going to be a good week. And week 28 is also a good week for S&P 500. And the QQQ is even more bullish. It's essentially straight up between now and mid-month. In terms of the weekly breakdowns, we are seeing, potentially strong increases later in the week for this week, and very good week for next week. I know we've just broken the all-time highs recently, but it might pay to stay in the market a little longer for this month until the mid-month. So that's it for today. If you liked what I shared today, please like and subscribe to the channel, and we'll have loads of fun on this journey together. Thank you.